Hey, welcome back, options traders. Well, we've talked about synthetics in many previous videos, and for those of you who may not be familiar with synthetics, you can certainly search for that keyword on my channel here, and you'll see a lot of different videos talking more in detail about them. But I wanted to address it from a different standpoint, because many times traders say, what do you need synthetics for? I'm not really going to do any of this fancy stuff. I don't need to know them. Well, that's really a bad approach because synthetics can give you beautiful insights into strategies, what to use, what not to use. And as we're about to find out, there's another benefit. You can also discover when people are telling you bad information. So let's go find out more about the importance of synthetics, or what's wrong with this chart. And as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's start off with a quick review of synthetic positions. Remember what these are. They're simply two different sets of positions that produce the same risk graph. That's what makes them synthetic equivalents. So there's a basic formula you can use to figure out synthetics, and we can look at a call is the same thing as stock plus put. And what you can do is just rearrange these algebraically to figure out what stock would be, or a put, or a short stock. You can just use that same equation to figure out different forms of synthetics. So the thing to understand is that any one of these can be made up from the remaining two. So for example, let's look at a risk graph for long shares of stock. We've got this 45-degree line, straight line, delta 1 forever. That's a long stock position. We can also compare it to a long call. So if you look at this, remember our long call has that bend in it at the strike, and this is a positive delta position. So the reason that that line is angling up that way in the call is really from the long stock. Synthetically, when you buy a long call, you control shares of stock, and that's what's creating those long deltas. And now we can figure out synthetically, well, if I'm trying to figure out a long call, it must be a long something else with it. Well, obviously I can't use a call as part of the answer, so it would have to be a long put. And there we go. We can see that a long call is the same thing as a long put plus long stock. And that's what we saw on the previous screen. Long call equals long shares of stock plus a long put. Again, notice the connection. If you're trying to figure out a long call, the answer has to be a long something else. Now, if we're trying to figure out what a call is, a call can't be part of the answer. And then we just have to figure out where the deltas are coming from. And so you can use this equation to figure out the 6 basic synthetics. So let's just start with the long ones: long stock, long call, long put. You can use that formula to show that a long stock would be the same as a long call and a short put, or more briefly, call minus put. So if you buy a call and sell a put with the same strike, it will behave exactly as long shares of stock. Long call and a short put is a synthetic equivalent of long stock. You can use that formula to see what a long call would be, and that will come up to be stock plus put. If you buy shares of stock and buy a put, same strike as this call over here, they will behave identically. So stock plus put is a synthetic equivalent of a long call. They'll produce the same risk graph. What about a long put? Well, use that formula. It'll tell you that it is short stock plus a call. So if you short shares of stock and you buy a call, it will behave exactly like a long put. So once you understand the long versions, it's real easy to figure out the remaining 3 basic synthetics. We're just going to flip them. So if we're trying to figure out short stock, just flip these around. It would be long put and a short call. So put minus call would be a synthetic short stock position. What's a short call? Well, if a long call is stock plus put, a short call must be the opposite: short stock and short put. And that would be a synthetic equivalent of a short call. And then finally, let's take a look at a short put. If a long put is short stock and a long call, then a short put must be the opposite. It would have to be stock plus a short call. Now notice this over here on the right is the same as a covered call. That'll turn out to be important in just a moment. So if you have a covered call position, usually considered to be conservative, it is behaving exactly as a short put, usually considered to be among the most speculative. Another interesting point, most brokers will require the lowest level of options trading approval to do a covered call. They will require the highest for a short put when they are exactly the same thing. So now let's go find out what's wrong with this chart. This came from another book that I was looking through, and this author was showing a list of bullish strategies. And he shows some that are among defined risk and some that are undefined risk. So take a look at this first row right here. The covered call, he says, is defined risk, but the naked short put is undefined risk. They're exactly the same thing. And this is a very good use of where synthetics can protect you. A lot of traders end up using the covered call because they think it's very safe defined risk. And then they will completely avoid the naked short put because they've heard it's the most dangerous strategy and they are stepping into the identical trade. So for instance, here's the risk graph for a short put. Notice that the angled part of the line right there is coming from long stock. What did the formula say? Well, if we're trying to figure out what is a short put, it's got to be a short something. Can't be a short put, it's got to be a short call. So we know that a short put is the same thing as long stock and a short call. And isn't that the same as a covered call? There we go. Short put equals long stock plus a short call. That is the same risk graph you will get for a covered call. So there we go. There's the covered call on the left. There is the naked put on the right. And yes, the author is right. You do have what's considered to be unlimited risk with the naked put. But then why does he say it's defined over here for the covered call? Look at that. They both bottom out at a stock price of 0. In exactly the same rates at exactly the same times. There's no difference between the two because they are synthetic equivalents. So remember, there's nothing wrong with a covered call. Just realize you are taking the identical risk as somebody who is selling naked puts. So again, it's kind of interesting why brokers would require the safest level of option approval for the covered call, but the highest level for the naked put. And synthetics show why that's kind of a curiosity. Let's go back to the chart here, and we see some more bullish strategies over here on the left. Defined risk, a put credit spread. Everybody loves their credit spreads because they think they are getting paid. But nowhere in this list is a debit spread. What's wrong with the debit spread? See, people think, oh, that must be undefined risk. Let me just do credit spreads. Well, what if the credit spread has a huge skew acting against you? It might be the worst of the two, and yet you would be led to step into it because he lists it as a defined risk. So remember what a vertical spread is. With the bull spread, we have a debit and credit version. That's true for the bear spread as well. So let's say the stock is 105. For the debit spread, you might, let's say, buy the 100-105 call spread. For the credit spread, you might sell those same strikes, but for the put spread. If you sell the 100-105 put spread, then it is a credit spread, but they will produce identical risk graphs. Now notice that both of them are selling the at-the-money strike, the 105 right there. That's where the stock is. So if we look at the debit spread, this is the risk graph. There's the bend at 100, that's our long strike. There's the bend at 105, that's our short strike. For the call spread, if you spend 2 and can make 3, then what's the credit spread going to look like? Got to be the same thing. So for instance, if we have, again, the debit spread over here as 2 with a maximum of 3, if we look directly across the board for the credit spreads, it will be trading for a credit of 3 and therefore a maximum loss of 2. And we can see they are absolutely identical. And so why would this author say that the defined risk comes from the credit spread but fails to mention the debit spread? See, in the real world, you might not get exact parity pricing like this. You might, for instance, only get a credit of 290 for the credit spread and therefore have a maximum loss of 210. But over on the debit side, you might actually have a maximum gain of 3, which would certainly be better than the max gain of 290. And yet you would never entertain the idea because he never mentioned that a debit spread also has limited defined risk. So once again, it was really just to show the importance of synthetics. So if you're new to options trading, it might be a tiny bit difficult when you're first exposed to it, but it's easy. You will eventually get it, and it will help to keep you from stepping into so many traps that other traders are touting. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.